Across the Queen City, inside executive boardrooms and high-tech startups. From research impacting the future of how we do business, to providing critical infrastructure to keep business moving and to keep workers safe. For more than 50 years, Business Niners have been at the forefront as doers, bold leaders, and change agents, driving business in Charlotte and beyond.
Hi, everyone. I'm Jennifer Troyer, Dean of the Belk College of Business. Welcome to all of you to the first Dean's Leadership Series session of 2021. So we launched this lunchtime session back in September. It's part of our year-long celebration of our 50th anniversary of the Belk College of Business. The Dean's Leadership Series really has multiple purposes. It's to celebrate our golden anniversary, as well as to give back to the Charlotte community by welcoming distinguished guest speakers, executive business practitioners, and other thought leaders who share their insights and experiences regarding current challenges and future opportunities facing our business community. So the COVID-19 pandemic has had far-reaching effects on businesses and the economy. Risk management is really helping to inform and guide businesses and individuals as they manage the impact and develop post-pandemic plans. So for our session today, we have a diverse panel of North Carolina-based risk management and insurance leaders. And they're going to be offering a broad perspective on a number of emerging issues and trends. It should be a great conversation. So now I'd like to introduce you to our moderator today, Mr. Tom Marshall. Tom is a senior lecturer in the Department of Finance in the Belk College. A little bit about Tom. In 2019, he was the inaugural recipient of the UNC Charlotte Award for Teaching Excellence. From 1988 to 2004, he served as Regional Vice President of Auto Owners Insurance Corporation. In addition, he chaired the governing committee of the North Carolina Rate Bureau, which is statutory responsibility for all automobile, homeowners, dwelling, and workers' comp rate filings in the state. He also served on the board of directors of the North Carolina Beach and Fair Plans and the South Carolina Beach Plan. So Tom, welcome to the Dean's Leadership Series.
Thank you so much, Dean Troyer. It's my pleasure to be here today. And I want to start by introducing our panelists. First, I'd like to introduce Tim Flanagan. He is president of Mass Mutual Carolinas, which is based here in Charlotte. And he's also a member of the Belk College Board of Advisors. Tim, welcome to the Leadership Series.
Thank you, Tom. It's good to be here.
Thank you. Next, I'd like to introduce Albie Knight. He is the Chief Executive Officer of the Independent Insurance Agents of North Carolina, which represents nearly 1,000 independent agencies throughout the state. Thanks for joining us, Albie.
Glad to be here, Tom. Thanks.
Now I'd like to introduce Jessica Medlin, Senior Vice President of ECM Solutions, an independent insurance agency with offices in Charlotte and Greenville, South Carolina. Jessica is a 2005 graduate of the Belk College, earning her bachelor's degree in finance with a concentration in risk management insurance. Glad to have you with us, Jessica.
Glad to be here. Thank you, Tom.
And now meet Darren Stafford. He is the Chief Financial Officer of Amwins, a global specialty insurance distributor located in Charlotte. Darren is a proud graduate of the Belk College, earning bachelor's degrees in accounting and finance. Thank you for joining us, Darren.
Thanks, Tom. Glad to be here.
I want to start with a few questions for each of the panelists, and then later we'll take your questions via chat. I want to begin with Albie. We know that insurance is an essential industry providing protection and security to individuals, families, and businesses. And during the last several years, insurance technology, we call it InsurTech, has had a growing impact on the insurance industry. To what extent has technology impacted the agent-client relationship during the pandemic, and what trends do you see emerging in the forecast for InsurTech?
You know, Tom, with insurance agencies, really probably like a lot of businesses during this time of shutdown and lockdown, agencies were having to transition, and regardless of really where they were kind of on the continuum of technology and the implementation of technology, everybody was looking to get a little bit more technologically savvy, particularly as it relates to being able to accommodate a remote workforce, as well as being able to interact with customers on a more remote basis. So with a lot of insurance agencies, they were well equipped to do that right out of the gate, and a lot of agencies were trying to figure it out on the go and moving over to voice over IP telephone systems and really embracing things like video conferencing to either meet with clients and also to have staff meetings, those sorts of things. What we really didn't see a big movement towards, at least not yet, which is kind of in customer acquisition. Agencies that were doing well in terms of identifying customers through digital marketing. I think they have fared particularly well throughout the pandemic. Agencies that were more traditional in terms of still relying on face-to-face events and Rotary Club and Kiwanis Club and things like that. Obviously, those types of activities were limited, and I think a lot of agencies saw decreased opportunities in terms of new business from those types of activities. But certainly, technology is a huge component to any business right now and their success, and the insurance agencies no exception to that by any means.
Okay, great. Thank you, Albie. I want to direct to Jessica. Jessica is an independent agent. And so tell us how the pandemic has affected the way that you work with clients, Jessica, and particularly in areas like helping them with risk analysis and risk management solutions.
Yeah, well, the pandemic has definitely changed the way we communicate with clients. It's allowed additional virtual platforms, and it's something that we were able to adapt to easily because we had those all available to us. It just became a lot more acceptable because of restrictions that were placed on clients as well. They didn't necessarily want to do that before. I use the new ways to communicate on a daily basis, as we're doing now with Zoom or Teams or whatever it is that the clients have available to them. It allows more touches. It also allows more efficiency and saves time. But with that said, it's only added a way that I, as an agent, communicate. It's not changed completely the way we do communication. Because when it comes to the agency side, we wear a lot of different hats. The client sees me as the agent, but what they hear is underwriter, company, car salesman, whatever it is they want to do, I am it all. They don't understand, unless you're in the insurance world, you don't understand the differences that each person plays when it comes to it. All they see is me in the end. And so I can't change that. So I am not going to change the way I communicate unless they are asking me to for one reason or another during this pandemic. My husband jokes with me that I sell words on paper and I'm not really doing anything. And while he kind of really knows what I do, I think most clients do see that as well. They see it as, a very expensive, intangible object. And if we do it all virtually and, lose that personal touch, lose that face-to-face, that lack of trust is going to go down. It's already hard enough to see what they're purchasing or to see that, and to bring that in a completely virtual world, I think is going to be completely impossible. So we got to continue to do what we've always done. And I can't speak for all agents. They can only speak for what I'm doing and what some of my counterparts are doing within my office. I know this is going to be a shock to people, but most people don't like talking about insurance. They don't see me and they're like, yes, I had a dream about cyber liability last night and I want to tell you about it. So I know, shocking, and I don't understand it, but it allows me to bring a little bit more to the table than just that intangible object that they're purchasing. It just brings another level of value, trust, all the different aspects that I think is important when it comes to the agency side. So while I have implemented new ways of technology and use those I've only made myself more efficient and more effective to the clients and allowed more touches to clients and prospects instead of using that as just a new tool.
Thank you, Jessica. I've always thought of insurance, and I know you share that with me as well, is we're making a promise to pay to help them in the future. And that's been just so extremely rewarding. And I'm sure you discovered that as well as an independent agent, that you're able to help people resolve problems and work through crises.
Oh, yeah, definitely. That's what I do. Like I said, that we're a one-stop shop and as a one-all to the person. No matter what company they're with or who they're talking to, I'm that person that's going to continue to solve their problems. And having that trust is going to make us more than just that one-dimensional object that they see, virtually.
Right. Let me direct the next question to Tim Flanagan. Tim, the pandemic has had a profound impact on individuals and small businesses. How have you seen people's behavior change regarding risk management and their personal financial affairs? And what are your recommendations for individuals and businesses for achieving their current and future goals?
Thanks for having me here today, Tom, and I'll take the first question. Yeah, we've seen a fairly significant change. The thing that's interesting about our COVID experience we're now coming up on a year with here as a society, a country, is, they celebrated, and I don't think celebrate's the right word, but commemorated the 500,000th death in America this week with a service in Washington. And, the whole COVID conversation, I'm sure everybody on this call has either had a family member with it, and has had an experience. And it's quite frankly elevated people's thinking about their own mortality and the impact of death, since it's been such a mainstay in the media. So that's one aspect that's changed, and it's made people more cognizant of the fact of having their financial affairs in order. The other thing that we've seen behaviorally is people wanting to have a plan. If you're a business owner or an individual and you are affected financially adversely through COVID with a disruption in your business or your employment, just not having your financial affairs in order. So there's a huge uptick. There's tons of studies different organizations are doing, seeing a big increase in people's desire to have their financial affairs in order. And that's been two of the biggest changes we've seen. And then for those that have put their financial affairs in order, kind of going back and taking the time, we had a joke early in COVID is after you've cleaned out your closet, your garage, your attic, go back and, time to clean up your financial affairs. And a lot of people, that resonated with them early in COVID. We're pretty far into the cycle now, but so that's behaviorally what we've seen, just a higher increase of awareness and desire to pay attention to it. From a recommendations perspective, I think keeping things simple is super important. There's a lot of, to Jessica's point, there's a lot of lingo and terminology that people in the financial services field, insurance field, risk management field may use that are intimidating to clients. But I'd say the simplest thing is to have a plan. We always tell clients or prospective clients that you have a plan, whether it's the one you want or the one that will happen in the event something happens, and might as well build the one you want. And so, whether that's understanding cash flow, budgeting, debt management, it's a huge fundamental component. The risk protection, understanding, where your exposures are from a risk perspective across the spectrum. Savings, having an appropriate savings plan, and then a longer term savings and investment plan. And again, I mean a plan, not in the sense of just where's your money allocated investment wise, but what is what do you want to have happen in a variety of scenarios? And that's another piece of that plan, is kind of scenario planning. I think taxes are always an issue and probably will become more as the government continues to pump stimulus into the economy. There's going to be a corresponding increase in taxes. And then really the last two pieces are overlooked often, but a big part of risk management and financial security is having the right estate planning documents. And some people hear estate planning and think, well, that's for rich people, but it's for everybody. I always tell people, write your own will, because if you don't, the state of North Carolina has one for you and you probably won't like it. So invest in getting one. but get healthcare proxies and all the, different powers of attorney, which again, in a COVID situation, with people being in the hospital, not being able to make choices is becoming more relevant. And then lastly, share that with your loved ones. And there's a lot of different platforms you can do that with, but putting all that together and then sharing it so people have access to things. But those are really, again, kind of keeping it simple, the recommendations that we make day in and day out to clients. And, it's intuitive, it makes sense. It doesn't need to be complicated. It just needs to be organized.
Thank you, Tim.
You're welcome.
I want to direct the next question to Darren. Business income insurance protects business owners from loss of income following physical damage to their property. During the pandemic, many business owners have experienced significant loss of income because of drop in demand, and in some instances, businesses have closed. Does business income insurance cover loss of income from the pandemic? So could you explain that to us, Darren?
Yeah, sure, Tom. And I would say, look, there's been lots of impact, obviously, from COVID on small business. And, your heart goes out to folks who've worked really hard and been completely disrupted by this. But generally, most carriers would say business interruption isn't covered unless there's physical damage. And most carriers actually have specific language in their policies that include physical damage triggers. They also generally include exclusions around things like COVID and infectious diseases, which all were added kind of after the SARS outbreak. The insured would argue that, hey, the loss of use is a form of physical damage, and so they're entitled to claims adjudication. And so obviously both sides are highly emotional. The carriers would argue that, if you want to retroactively change the financial contract that's previously negotiated and agreed, that's probably unfair, right? If they had intended to cover some of these, they would and do so with a sustainable business model. The pricing around the coverage could have been different, some of the terms and conditions, all those. To kind of just hand that obligation back to the insurance carrier community is a bit unfair. And to put that really into context, right? You heard some numbers thrown out when COVID first happened. If you really accepted kind of all the business interruption claims due to COVID on their face, you basically would eat up the $800 billion of capital in the insurance P&C space in probably a couple of months. Early on, I would say members of Congress didn't help by piling on to the COVID thing and trying to remove themselves from the spotlight. And so you can imagine, there's been lots of lawsuits that have been filed, and folks have been debating the language that's inside of these policies for quite some time now. The last time I looked, there were over 1,500 lawsuits. As of now, I would say the carriers are probably winning in the courts, and the courts have agreed that insurers shouldn't bear the full cost of COVID. They've scored some early victories with dismissals based on the language itself, but I would say the fight really is kind of far from over. In fact, when you think about not only in the US, over in the UK, the Supreme Court in the UK recently overturned a couple of London cases that broadened kind of the coverage around BI and the prevention of access clauses that those policies contain. And really just this morning, I saw an article about a Chicago case where the judge had ruled against a carrier for summary judgment for a group of hospitality insurers that have, indicated pandemic imposed lockdowns really curtailed their business or closed them. So in reality, I think it's really kind of a wait and see. I think it's, where does the court case kind of play out? How and when do kind of COVID vaccinations happen, the government stimulus, how many businesses ultimately go out of business from here, and generally like how the economy fares in the next kind of 9 to 18 months.
We're seeing so much litigation, and that, of course, hits the insurance companies because they have to defend those claims. And that's, I know that Lloyd's is putting up some substantial reserves, and I'm assuming some of that comes from litigation, and probably some comes from perhaps they may have a little bit broader contracts in some instances that would extend coverage.
Yeah, there's a couple notable carriers where they either didn't have very clear language or had no language at all, and they've added substantial reserves and probably need to. Based on the interpretation.
Let me go back to Albee. Albee, on February 16 in the Business Insurance Journal, it was announced that Oscar Health had announced that they needed to start hiring and appointing brokers to continue their growth. Now, I'm sure you're familiar with Oscar Health. That's one of the technology firms, InsurTech startup firms for health insurance. So what does that, do you see that as an opportunity for agents to provide more choice to consumers? Previously, we've seen that some InsurTech sales has been more of a disruptor, but and I know that was kind of the case in the early years, but now we seem to see these trends where we're seeing the technology firms actually looking to hire agents to work with clients in person. So
Yeah,
what,
I
do
think
you
you
see
really,
that trend?
yeah, I think you really just identified the trend there. I mean, a lot of InsurTech early on were really designed as disintermediators, if you would. Really were designed to disintermediate the agent and to do business directly with the consumer. And a lot of those grand plans and visions have shifted, and they realize that in many instances the agent, brings a very viable option for distribution. And really, I mean, you look at the future of the agency system is really bright, I think, because technology is going to allow the independent agency system to compete and provide a lot of the conveniences to the consumer that these InsurTechs have been trying to bring to the marketplace. And I think the reality is that a lot of these InsurTechs now see that agents have a couple of things that are tremendously valuable and are very difficult to replicate, and that is they have the customers, and then they have the relationships that generated those customers, and that's a very powerful combination. And so a lot of these InsurTechs are now really looking to partner with agencies, and I don't know of anyone that's really been able to do that successfully yet. So it'll be interesting to see, because I think on the surface, a lot of agencies see these moves towards using agencies for distribution as exactly what they are, which is really just kind of a temporary, let's partner with agents as long as we need to until we can figure out how to get around agents. So I'm not really sure how welcoming independent agents are going to be to some of these InsurTechs that have kind of changing their tune in the middle of the dance, so to speak. So, but we'll wait and see. One thing about independent agents is they all operate independently, and you'll have some that will embrace the opportunity, and you'll have others that will say, not in this lifetime, sir, but good luck to you. So it'll be interesting to see how that goes.
Right. Okay. Thanks, Albie. Let me go back to Jessica. Jessica, one of the biggest areas that we're really seeing a lot of claims activity is in workers' compensation, and that means that as an agent, you would be spending a lot of time working with clients, helping them with loss control and also with claims. So could you talk about that? If you can't, whether I would think you would want to do that in person, but tell us how you would handle how you would focus on loss control to help clients with those claims issues.
All right. Well, there's a couple questions in there. The loss control aspect, I would partner with carriers or third parties that specialize in certain areas, because I work with so many different types of people, and we can do it a couple ways. We can do it in person, but what's been very beneficial for several of my clients is some of these virtual tours. It saves them time and still gets a lot of the same aspects accomplished. So when it comes to the beginning phases, doing some of this virtual has been beneficial, but really being in person and digging down into it is where you're going to see all aspects of it. And then going further to your next question on the work comp, seeing a rise of claims when it comes to COVID, because occupational disease is included under workers' compensation. The thing is, every state operates differently. And in the state of North Carolina, we are seeing a lot of denials right now, because it is on the employee to prove that they not only contracted it from their job, it was due to what they were doing that gave them a higher risk than if they were to get it in the general public. And then it was their employment that actually was where they contracted it. And right now it's really, really hard to prove. And if you're not going to do that in the state of North Carolina, they're most likely going to deny it. Now, back in September 2020, California amended their law to where they put the burden on the employer. So it's the exact opposite. So it's going to be interesting how that, trickles down and is affected in how people respond, or if anyone else adjusts it. But the employer has to prove that the employee did not contract COVID-19 or the disease there. So I think like what Darren was saying with business income, it's going to come down to a lot of court cases and what is ultimately going to happen. And for years to come, we're going to kind of see it play out as we continue to discover how this thing affects us, as a whole. But each state, again, is operating differently.
Jessica, that's very helpful. And I believe there's some legislation, and Albie can kind of respond to this as well, both of you, that there's some legislation in some states, and I think legislation pending in North Carolina, that has presumptive coverage for certain categories. For example, first responders, doctors and nurses, that if they contract COVID, that would be a workers' comp claim. And
well, for those cases, it's easier to prove that it was due to their job they were put in that situation.
Right.
And so that is one of the items in work comp, but I don't know if Albie wants to add to that as far as the additional legislation that's provided in there. But like, my husband's a police officer, and, he has to go on scene. He can't stop, like, wait, do you have COVID? It's unfortunately, they're going to have to go into that, and that is putting them at a higher risk. And therefore, yes, that would continue to increase claims, in my opinion. But that's not a majority of the people that I typically work with.
Albie, can you comment on that legislation in some states or North Carolina? My recollection is that North Carolina legislation was pending that would presumption of workers' comp for first responders.
Yeah, that's my understanding too, Tom. I don't really have much to add there.
What we do see is that certainly we are seeing claims on the workers' comp side related to COVID. And the other thing, Jessica, that you could comment on is that ultimately there's going to be a big shift in the premium as well, because with premiums going down in some businesses because of layoffs, particularly maybe retail or hospitality, the premiums are dropping, which means there's much less premium base going into the workers' comp program. And with still the same amount or greater number of claims.
Yeah. Well, and this is my interpretation of what's going on, but rates are almost 50% down than they were from 2008 in the workers' compensation market, and they can only go down so much further if they've not already bottomed out. So there was only one direction that the rates were going to go anyway, and it takes 3 to 4 years for us to effectively see how current rates are trending. So this COVID, I think, is just going to increase that process faster, because there's going to be a knee-jerk reaction to make sure there's costs to cover whatever claims do come out of it, on top of the already claims that are going to cause issues with the workers' compensation market.
Let me go back to Darren. Darren, we talked about limits, and we're also seeing not only you talked about the business income coverage and the issues there, and also the workers' comp, but we're also seeing a lot more litigation in our society today. And that's been an issue in driving up rates and having a greater demand for the client to have coverage, particularly in the CGL coverages, probably the directors and officers coverages. Another is event cancellation. It is, has a dramatic impact on having to have big needs. So where is that? Are we going to have that capacity, or what is your feeling about that to handle these CGL claims and limits?
I would say it's been really interesting, kind of, at least relative in kind of the P&C market for the last kind of 18 months. I mean, look, there's a volatility in the market, and it goes in cycles, right? Capital comes into the market, drives prices down. They go to a point where capital leaves the market because it's not an attractive return, and then it comes back when there's a reasonable chance going forward. Look, I think specifically there's been lots of dislocation in the market in the last 18 months. And so we've seen prices, as you mentioned, going higher and higher and higher. I think we'll see that for the next probably 12 months at least. And then we'll see potentially the cycle tilt back. I do think that there's been capital sitting on the sidelines to now. We're starting to see additional capital coming into the market. And I think we'll continue to see that as rates continue to drive kind of overall profitability and make the market more attractive. You'll see capital coming back in. And so I think that will help from a capacity perspective.
Okay, thanks, Darren. One other issue, there's been a lot of conversation, particularly around the business income coverages and also the storm-related coverages about what we call parametric coverage, where it would simplify a storm claim if it fell within a certain parameter, like within certain coordinates, it's going to be covered. If it's a certain intensity, and that same theory would apply to business income. Rather than that physical damage and having to pull out all the accounting statements, if a certain event occurs, it would just create coverage. So, do you see that on the right? Do you see it now? And do you see that coming? Parametric.
We do, and we actually have some folks that are focused on parametric. I would say it's in its infancy now. I mean, the idea and the model does address lots of the kind of critical business issues that exist there. We haven't seen a ton of folks responding to it yet, and I think it's just because people don't fully understand and appreciate it. They're a little tentative from, the concept of potentially what they thought they were covered or were not, from previous rounds here. And so I do think it will become more and more important. I do think, business interruption, I think that debate's going to continue for quite some time. I think we'll have to let the courts and other things play out, but I do think the industry will respond to that. At a minimum, I think my personal view is you're going to end up with something like TRIA, whereas, back when 9/11 happened and you had terrorist coverage that everyone wanted, but there wasn't really a viable model, you ended up with a public-private kind of combo where the government's backstopping in the event of some catastrophic loss. I could see an opportunity for something like that around business interruption, where you want to promote the carriers to write as much as they possibly can, but also give them some assurance that there isn't going to be a complete insolvency if doomsday should happen. But I do think we're probably a little early in that, but it should play out, I think, in probably the next 24 to 36 months.
Okay. Let me go back to Tim Flanagan. Tim, you may have noted this in your prior discussion, but let's talk a little bit about life insurance. And that's based primarily on mortality and, of course, individual underwriting. But what is your view on that? Where do we see life insurance rates going? And how do you advise clients about that?
Yeah, so there's actually a lot going on in the life insurance industry right now. It is interesting. I think, the average age of death has come down in the United States as a result of COVID in the last 12 months. And mortality being one component of life insurance is definitely a factor. The bigger factor, there's a couple of bigger factors, Tom. One is actually interest rates, because life insurance products are extremely interest rate sensitive. And, with the 10-year treasury finally back up above 1, which is a kind of an interesting way to look at it, but, bouncing below 1 for a long time, it's put a lot of pressure on insurance companies and some of the guarantees they have in their products. And so that's one factor. The other one is technology and insurtech. I've been very interested in that for a number of years, and you're seeing a lot of different things come into play there, which in theory drives down the cost of issuing life insurance products. So that's a positive trend. I would agree with the other panelists that that's probably going to be better with a live person than purely, that's at least the trend I'm seeing, is a lot of more effective insurance tech is marrying up with a live person. But on the pricing side, there is a fundamental shift taking place this year. And this may be a little boring, but real quick, the Internal Revenue Code that dictates the guarantees in life insurance products with guarantees is called 7702. It has changed. It was changed in December of last year in one of the last stimulus bill of last year. And it effectively lowers the guaranteed rate in permanent life insurance products from 4 to a minimum of 2. It's actually going to become a floating rate, but the minimum is 2. It takes a lot of pressure off insurance companies. The aspect of that for the consumer, though, is quite frankly, with a permanent, product that has guarantees in it, those guarantees will be 2% come next year or sooner for some insurance companies. A lot of them will try and reprice as quickly as they can. They have to be repriced at some point next year. So that'll bring the guarantees down, and the impact of that will actually be death benefits will go down and premiums will go up. So there's a few moving parts there. So in reality, the products that are available today and have been for, a few decades are going to be very valuable come next year, because most of them, if not all of them, have 4% guarantees. There's a few that have a little higher, but not many left. So it's definitely a transitionatory market this year. And, I think the net effect is the cost of death benefit in the future will actually go up, again, more because of the interest rate environment, though, than the mortality life expectancy rates.
I had a question for the panelists. I want to, or from the audience, and I want to direct this to Jessica. It has to do with what is your feeling about the monumental increase in claims due to the Texas event, which was weather related, but also energy related. And I know that energy is the area that is your special area of focus.
Yes. So it's absolutely crazy, especially since they were considered on the leading edge of energy and technology when it came to their system, and the fact that a majority of people did not have power at least one point during their snowstorm, which is very unfortunate. But I also feel like they're the land of oil and gas. And so while they say they're introducing sustainable energy, I believe it's like 20% or less that's actually sustainable. The rest of it is older technology. And I completely get it from their standpoint, but I think they need to continue to increase additional options. And, as you said, I work a lot in the energy industry. And after reaching out to a couple different people that I work with, waste to energy would be a great option for them, because it would be able to continue to work during the process, during any type of climate, and continue to provide what they need in case anything were to happen. And obviously they got to do additional items like winterize, and continue to protect the core source of whatever they end up using. But I think, and it's just an unfortunate incident that with the claims and the amount of money that's going to go out, but they really need to start focusing on the future. And it's going to, no matter what they end up doing, there's going to be a cost associated with it. But looking at the alternative sustainable side is going to be very beneficial to them, to not have something like this happen again, and for other states to learn from it.
Hey, Tom, this is Albie.
Yes,
I'd like
Albie.
to add a little something.
Sure.
I've this week I've spoken to a lot of the top property insurance brokers in the country. They all see this as maybe a market changing type of an event. No one really is going to dispute whether there's coverage or not. I mean, this is going to be a covered type of an event, and you're looking at billions of dollars. So, I mean, this is a type of an event that is going to potentially change reinsurance treaties. This is going to impact property rates across the country, I think, in a relatively short period of time. So that's what I'm hearing in the marketplace right now, is that this is potentially going to shift insurance costs for everybody.
I agree, Albie. I think it's really dramatic, and related to climate change, and really related to COVID, because when Texas went through this crisis, the hospitals were shut down and the vaccinations stopped. And so it had a huge impact on everyone. And one lesson I think was learned as well is that Texas has said one of the problems that they've admitted is that the equipment wasn't winterized. They just think, well, in Texas, it's not going to get that cold. And most, Jessica, I think you would agree that most energy firms, like I think Duke Energy commented on that's got a kind of number one rule on loss control.
Yeah, I'm sure at the time it helped with cost, but now they're rethinking that.
Right. Yeah, you don't have to spend money on loss control, but then you end up with billions of trillions of dollars of claims. So we had another question from one of the audience members from the chamber. Notes gratitude for the North Carolina General Assembly for adopting safe harbor laws protecting against COVID claims by employees, except in gross negligence. And that order expires, or that particular particular item expires after it expires at a certain time, I guess 180 days after the governor's order. So how will businesses plan for the future going forward after we get through that safe harbor period? And that would relate. Yeah. Yes. Good.
Yeah. So Tom, this is Albie. The General Assembly is currently working on a longer term solution to that. I was texting with Joe Stewart, our lobbyist, our VP of Governmental Affairs, and he was telling me that the NCOIL, which is the National Conference of Insurance Legislators, is working on some model legislation, and so that's currently being considered, and certainly urge everybody to take a look at that and contact your legislators, and particularly those of us in the business community, being able to extend that the release from having liability associated with your company because of COVID. That's really, really important to being able to continue to operate your business. So contact your legislators and encourage them to support that initiative.
Okay, thank you. Jessica, another question relating to workers' comp is ergonomic claims. Have you seen an increase in that as people, more people, I guess, working from home, or just doing on the computer?
Yeah, I personally have not. I know there's been some information out there as far as people working from home and potentially having claims, but I think, again, in the state of North Carolina, it'd be very hard to prove working from home that it was work related that you were injured.
Let me go back to Tim. Tim, can you give us some thoughts? This is a pretty general question, and and the college has an economic update coming up shortly, but what are your thoughts about whether the economic projections for 21 and 22? Where's the U.S. economy going?
You are right, Tom. I am not an economist. I would say, as a business owner, anecdotally, what I see and what concerns me, obviously, are, I think, the financial effects of COVID are not over yet. At the same time, there still seems to be a tremendous amount of capital in the markets. Obviously, the stock market right now is rather frothy, and the ability almost for people to speculate off of different fintech apps in the markets a bit concerning at this point. We've got a significant amount of debt, and again, I'm not an economist, but my memory from my econ classes in college tells me that when we're printing the money, we're printing. There's a good chance taxes are going to be higher, and there's a possibility of inflation. So it is very interesting. I mean, I would say that I've seen businesses that are having the best of times, and I've seen businesses that are having the worst of times over the last 12 months. And some of it is, quite frankly, the industry you're in, and you're just kind of not immune to the fact that COVID really did have a direct and profound impact on your business. Some of it is the mindset of the business owner and the business, and the decision they made to plow through it as opposed to wait it out. And some of that's the ability to pivot with technology mindset. But I think I always like to say the long-term economic outlook is optimistic, but the short-term one is always difficult for me, at least, to prognosticate. Other than what I've shared, it's definitely it's kind of a mixed bag right now.
Okay, thank you.
Sure.
Another question that is InsurTech related, and maybe any of the panelists that want to offer feelings about this. How are companies managing their claims if they're predominantly InsurTech? I'm sure they have to outsource that claims handling to another group, but how does that, can you comment on that? Are the claims being handled very efficiently if they're being through an InsurTech focused company?
I mean, I could say generally on the insurance, life insurance, disability insurance side, there's been an uptick in claims, and it's a confluence of events, including COVID. I think specifically on the InsurTech side, at least in my experience, Tom, a lot of those companies are relatively new players and might not be having that experience. I did see during COVID, especially at the peak last year, as bad as we had it here in the United States, most people could work from home, and a lot of insurance companies could pivot to that model. But those either insurance or investment companies that outsourced functions to different parts of the world, where those parts of the world were really shut down hard and did not have work from home capabilities, it got pretty dicey last year for a few of those companies. They scrambled and pivoted and figured it out, but for a period of time, it was a challenge. But, I think the interesting thing, at least on the life insurance side, or, the personal types of coverage is typically at the time of claim, that's when you want human intervention, not a website. And I think for at least the foreseeable future, people are still going to want to deal with another person versus a website to process a claim like that.
Yeah, I would add, I think that you asked the InsurTech question earlier. It's been interesting as someone who's newer to the insurance business. You can see lots of things that can be improved with technology, but you don't see a lot of things that can be replaced with technology. We have the view that folks like Jessica and what she does with individuals is the key part of insurance. And a financial contract, a claim settlement are complex things that you can make them better with technology and more efficient, but you're not going to replace that relationship base that someone, when they're in the uncharted territory, want to call someone they know and trust to help with that.
I know there's some areas of technology that's been a great asset in claims handling, and I think of drones particularly. If we have you have a big weather event and you can't get claim reps into the territory, you can send drones in to take photos, and it even makes it much safer. When claim reps don't have to climb up on a roof, they can have the drone take detailed pictures and then settle the claim on that basis. Also cuts on company expense as well. So that's certainly an element of technology that's been beneficial in handling claims.
But to add a note, it's still a human that has to fly the drone and do all those other aspects. And I think technology can make people lazy. I've had an account where their score on their building was 10 years old, and it was from the previous client. And because they had old drone pictures and old pictures, they just replaced it. And it made it a lot harder to insure the building until I got the information to resend in my own pictures, because they're not allowed to leave their offices to update it. And so I think there still has to be human touch to watch over the technology behind it.
100%. And I remember a story of, we were talking to an inspection company and they were going to get more efficient by using drones. And inadvertently, the drone went to the wrong house and took a picture of someone sunbathing nude, only to determine that lawsuit that followed that far exceeded anything they were saving in terms of the use of that technology. So,
right. Going back, Darren, I'll start with you on this one. Going back to the Texas situation with the climate and the power utilities, do we have enough capacity in the industry to handle those type claims?
Yeah, I think it will be interesting, right? I do think that markets are still, as I mentioned before, pricing has been really hard for the last 18 months. Double-digit price increases, and so while I think that I would have said through this cycle, absent Texas, that would start to attract more capital and thus drive pricing down. I think with Texas, it's going to soak up that capacity that was coming and probably need more. And so pricing is going to keep holding firm for probably at least the rest of the year, if not beyond. But I do think that will continue to attract capital into the space. So I do think there'll be capacity there. It will be tight potentially in the short term, but I do think capacity will respond.
Let me go back. Do you see any, we talked about legislation, and you mentioned a few things, but any other particular legislative issues that COVID related or otherwise that you want to mention that are pending in the state legislature?
Well, not COVID related, Tom, but our number one legislative initiative continues to be to pass a hands-free
Yeah.
driving bill in North Carolina. We think that's just a no-brainer from a public safety standpoint. When you look at after decades of reversal of trends in terms of automobile fatalities every year and pedestrian fatalities, I mean, there's been an uptick, and there's a direct correlation with the proliferation of smartphones. And so we think that it's past time to have a hands-free law in North Carolina, and that's our number one legislative priority for this year.
Okay, good. Thank you. Tim, another question for you. Would you share your outlook on annuities? And I'd like to kind of throw in also variable life and universal. How do you see those financial products?
Sure. No, I can. Yeah, I mean, I think, again, the annuity space has gone through a lot of change. A lot of it market related, but still in the right situation, it's the perfect product. I mean, you're guaranteeing an income that is difficult to do, and you're using the insurance company's balance sheet and mortality to do it. So it's definitely a good product in the right situation. I think you're going to see, again, in the low interest rate environments, put a lot of pressure on products. There's been some product innovation that does transfer a little bit more of the risk back to the insured. And at the same time, again, it's just a huge market. So you're going to continue to see innovation there. I think on the variable universal life side and universal life side, Tom, again, variable life is making a bit of a resurgence for sure. And again, there's a risk transference back to the insured, but there's some flexibility there. And those products were extremely popular in the 90s. And it is a little bit ironic that they tend to become very popular at market peaks. But nevertheless, that's what's going on in the variable universal life space. And the universal life space, again, has been pressured by the interest rate environment, making it difficult for companies to keep guarantees. So, although you have clients, especially older clients, that don't have the risk tolerance for a variable universal life type of arrangement, a universal life funded properly and attended to properly can be a very good death benefit play for either older clients or people maybe with more health issues that need the coverage, but do not want to put the money in that a whole life permanent insurance might cost.
I have another question that just to any of the panelists that want to comment on this. After the 9/11 attacks on the World Trade Center, there was legislation created called TRIA, the Terrorist Risk Insurance Act, which was a federal reinsurance program. And that program was put in there as kind of a stopgap to help fund that. Because all the companies stopped writing terrorism coverage, so TRIA was provided capacity to provide coverage in the future. And that legislation still exists. So my question is, do you see any TRIA type legislation that might be looked at for this business interruption situation? Anyone, Darren, you want to comment on that?
I'll start. I mean, I do think there's a possibility of that. I think you got to let the current situation play out a little bit, but I do see the opportunity for something like that coming down the pipe.
I completely agree with that. I think it's already being discussed, Tom, and it's just a matter of how the current situation is going to be resolved, and then it'll be interesting to see how how the carriers would be supportive of such a federal backstop.
Another question that just came in, and if an individual has a car in California and North Carolina, and due to COVID, they're not traveling, so they put their insurance, they combine the car, they put them under one policy to simplify the insurance needs. They get a multi-car discount in California, but not in North Carolina. Why is there no consistency in the industry regarding regulatory? And we just heard from Joe Stewart about the North Carolina environment, and I'm familiar with that, as my background with the Rate Bureau and so forth.
I think you're probably as well positioned as anyone to answer that question, Tom. If you want to go into your lecture, on this. on how insurance is largely state regulated, and the
Yeah,
rules vary per state
right.
quite significantly at times.
Yeah, every state is different. We're state regulated for insurance, and that's the way it's been historically. In North Carolina, we are a state that has a rate bureau, and companies do not file independently. So we have our own rules. Any other comments from the panelists regarding the risk management in general and how it's related to COVID? And one other thing I want to address real quickly is we've talked about all the businesses that have been downsizing and losing employees, but insurance is not one of those industries. Insurance is actually growing during the pandemic. We're actually adding employees. And that's something that's very important to me in communicating with students in the next generation.
Yeah, Tom, on that point, I'd add, certainly in the financial services field I'm in, you have a couple factors. Like I said earlier, you've got a lot more people interested in getting their financial affairs in order. There's been a huge uptick there. I mean, uptick in life insurance, disability insurance purchases. At the same time, you have a significant aging out of people in the industry. So for your students, either current or recent, the career opportunities to become a financial advisor are very strong and getting stronger.
Yes, absolutely. I agree with that. So any final comments from the panelists before I turn it back over to Dean Troyer?
No, but thanks for having us, Tom. Appreciate the opportunity.
Thank you.
Thanks to each of you for your commitment to the university in providing this program.
And congratulations on your award, Tom. That was great.
Well, thank you. Thank you so much. Thanks to each of you for your contributions.
Well deserved.
Thank you. So Dean Troy, I'll turn it back over to you, and thank you for making this program possible and for including this wonderful group of panelists.
Well, thank you, Tom. And I want to just big thank you to all of our panelists today. So I wanted to tell you about a few events that we have coming up. Please save the date for our next Dean's Leadership Series. That will be on April 15th. So that's going to feature a conversation between founders of two of Charlotte's billion-dollar startups. And then we have a series of other upcoming events. So next Friday, we have the UNC Charlotte Economic Forecast, where John Connaughton will tell you what he thinks about what's going on with the economy. And then we have 3 additional events lined up for March. We have Chris Peak, an alum of the Belk College and president and CEO of Caramount Health, will be joining us in our CEO Speaker Series. We have a Women in Business event that's featuring Kelly Earnhardt Miller, another alum of the Belk College. And then finally on the 17th, we have our Entrepreneurial Decision Series, which is being offered jointly with the College of Arts and Architecture this year. So please, you can learn more about our 50th anniversary events at belkcollege.uncc.edu/50 events. So thank you all for joining us today, and please stay safe.